2 p.m. in New York, it is 7 p.m. here in London, and live from Bloomberg's world headquarters. This is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Kailey Leinz. Taylor Ricks is off today.
And the bounce back is on. U.S. stocks halting the longest slump since September. The S&P 500 rebounding from a 4-day slide. Every industry group higher on the stimulus hopes. Meanwhile, there's more help on the way. Moderna's vaccine found safe and effective versus COVID-19 in the U.S. ahead of Thursday's meeting on its emergency authorization, building hope on day 2 of Pfizer shots being administered across the country. We hear from one hospital system about the rollout so far. And a last-minute rush for relief. House Speaker Nancy Pelosi reaching out to Senate Majority Leader Mitch McConnell for a meeting on stimulus. That's as Leader McConnell recognizes Joe Biden as president-elect for the first time. All that and so much more coming up.
Yeah, Caroline, a lot of confidence really coming back into this market today. I guess you can tie some of that to the prospects for fiscal stimulus finally making its way through Congress, it appears. You see the S&P 500 here up 1%. The Russell 2000, once again, your outperformer on the day, up more than 2%. And materials, though, interesting move here. We talk a lot about how commodities are a really good barometer of current sentiment about economic conditions. Well, materials, the stocks there, that gives you a little bit of a clue into the sentiment, looking out a little bit forward here. So you're seeing not only sort of the asphalt makers like Vulcan, the chemical companies, packaging stocks on fire today. Keep an eye on that sector as we move forward, because that could be an interesting barometer. Of course, we're also keeping an eye on treasuries. You're looking at 10-year treasury futures right now, down again for a second day ahead of that Fed announcement tomorrow afternoon. And wow, the dollar, the trend line on the dollar continues to be lower, below that 11.27 mark. Remember, that was your low back in 2018. Right now, the technicals seem to suggest that we could see further dollar weakness, Kailey.
All right, Romaine, well, let's talk a little bit more about fixed income, because Treasury yields are moving higher today to the tune of around 2 basis points on the 10-year note, right now sitting around 91, 92 basis points, but still stubbornly below that 1% threshold we last breached in March. Time and again, yields have tried to break to that level, and time and again, they have retreated. The question is whether that changes this week, depending on what we're going to hear out of the Fed tomorrow. And since there are just a handful of trading days left in 2020, I do want to look at what's expected for the Treasury market into next year. There is broad bearish consensus. Most strategists seeing that yields will move higher over the next 12 months. I would point out, though, as what we're looking at here, they basically always think that. The average forecast in every year for the past decade has been that yields will move higher. And as we know, that hasn't always happened, Caroline.
What's the definition of insanity again? I wonder. Kailey Leinz. Great, thank you so much. Let's focus in now on where yields are going. Let's get to it with the outlook for fixed income with Nick Maroutsos. He is, of course, head of global bonds over at Janus Henderson, who joins us from Newport Beach, California. Nick, it's always great to get your voice on the show. Where do you think yields are going?
Look, I don't think they're going to move materially higher. Positive news around equity markets. Obviously, the vaccine distribution is a huge. But ultimately, at longer term, bond yields are going to stay relatively in check. Permanent employment as a result of this crisis, we're still not out of the woods entirely, even though the vaccine is happening. You could see a bounce in yield in what the Fed does this week and with the vaccine news, but I think that you're going to stay low for longer.
Nick, I mean, the market isn't expecting, obviously, any change in benchmark rates. They do seem to be expecting some sort of update, I guess, on these Treasury purchases and whether that duration gets extended. I mean, our market participants right now may be a little too presumptuous that the Fed is going to do anything at this stage.
That's exactly what I mean. The market will likely be disappointed to some extent if it doesn't issue some form of forward guidance. You know, Powell, it's in his nature to try to outdove the doves, and he's done that previously through communication and other programs they've put in place. But I think it's okay for them to disappoint the market. What's going on? You have markets at all-time highs. They've continued their purchasing program. Like I said, the distribution of the vaccine is happening. Save that bullet for when it's heightened. Georgia election that's coming up the first week in June, which is going to be a telltale sign as to what the fiscal stimulus plan is going to look like. And if it doesn't go the market's way, then that's when the Fed can look to act. But ultimately, I think that they will, and you will see some form of guidance or yield curve control, because it's really not in the best interest to move higher. It is okay for them to push higher over a period of time, slowly, because ultimately higher yields is a good thing for the economy. It's not really good for the market right now.
Nick, you mentioned yield curve control there as a possible option. Do you think the Fed would actually formally adopt that?
You know what, Kailey, I don't think they will. They need to be very particular because the market tends to digest every single word, every single change in words. That they might issue some form of forward, but you will hear a lot more rhetoric come out of their mouths when it comes about where the yield is, which is why we're believers that the yield curve is going to steepen materially because standing behind there, and they can actually keep yield pretty aggressively. Not to mention the fact that, and what about previously is that, globally, U.S. yields they're pretty attractive on a relative basis compared to other sovereign markets, and ultimately, when things there is a flight to quality, be to treasuries.
I was going to go exactly there. When you look at global bonds, as in your name tag, I'm interested in where else does look in any way attractive. Where else are you putting your money? If you're thinking that there's a cap on yields in the US and perhaps it's the most attractive game in town, how much further are you going down the food chain into corporate, into high yield?
So that's the million-dollar question, Caroline, and there's no doubt that our opportunity set within the fixed income market is shrinking. There's fewer and fewer compelling opportunities. It's really difficult to call spreads wide at this point. The caution against investment, particularly in this late in the game when it comes to where we are in terms of how much things have appreciated, is to move down the capital structure too aggressively, because the further you move down the capital structure, higher yield or emerging market debt doesn't mean that it's not attractive, but it doesn't provide those effects that traditional fixed really does. What we're trying to do is we're looking globally in unique markets, or Australia, Canada, New Zealand, parts of Asia, ex-Japan, particularly the U.S. dollar denominated assets, and we're trying to take advantage of the new issue market where possible, because that's ultimately where you're getting some decent value. We're also focusing on the front end of interest rate, because we believe that has the highest ratio in terms of central banks not interest rates for a significant period of time. You take out the volume of the back end, whether or not yields go to 1.5, or even move 25 basis points, it largely doesn't matter for us because we're focused on the front ends.
So what's the reaction function at the front end of the curve here, Nick? I mean, we're looking at a 2-year a couple of sessions ago that was retesting those all-time lows. Is this purely a function right now of whatever policy change the Fed makes, or is there something more going on the front end of the curve that we should be paying attention to?
So, Romaine, I don't think there's much more going on than we already know in the front end. I think people are trying to look for yield where they can, and let's face it, 11 is really not that exciting, particularly when equity markets are up 2% in a particular day, right? It's hard to make a case for a decent amount of yield in that space. But for us, it becomes, again, more about where is this risk that you can take in the fixed income market, and that continues to be the front end, because, like I said earlier, the bar for central banks to be hiking interest rates is right now. The Fed has said they're not going to be hiking it. Not 2020, notoriously been over-promising and deliver. If you look back to the crisis back in, they waited 7 years to start hiking interest rates.
Yeah.
And the year they promised 4, and they only did 1. The following year, they promised another 4, and they only did 1. So our expectation is going to be on for much, much longer than what people think, because they're going to have to unwind a lot of this stimulus, make sure that we're out of the woods entirely.
Nick, always a pleasure to get you on this program, get your thoughts on things. Nick, we're going to have to leave it there. That's Nick Maroutsos, head of global bonds over at Janus Henderson. Now, coming up, a lot more on this program. The next stamp of approval, the Moderna vaccine found safe in an FDA report. We're going to talk about how that second shot could boost the country's immunization efforts. Plus, a negative outlook. We're going to speak to Raimes of Moody's. We're going to talk about the long-term impact of the economy on state and local governments. Taylor's gone, but Muni moment persists. And let it snow, let it snow, let it snow. If you're living in the Northeast, brace for the biggest snowfall that we've seen so far this season. Could have a big impact for anybody up and down the I-95 corridor. All that and more coming up next from New York and London. This is Bloomberg.
Progress continues to be made on the COVID-19 vaccine front. Moderna, in all likelihood, set to become the second vaccine candidate approved by the U.S. after an FDA staff report released this morning found it safe and effective. And of course, Pfizer has already begun to roll out its vaccine this week. But the fact of the matter is, it could be months before enough of the country is vaccinated to achieve herd immunity. And in the meantime, the virus is continuing to rage. You can see cases climbing here on GTV Go and hospitalizations climbing as well from New York to California. 3 of 5 regions in California are now under mandatory lockdown. And here in New York, Mayor Bill de Blasio saying today we can expect a shutdown of all essential businesses soon after Christmas. So things could get a whole lot worse before they get better, Romaine.
All right, for more, let's bring in Dr. Dan Roth. He's the Chief Clinical Officer over at Trinity Health. It's a health system that operates 93 hospitals in 22 states, as well as 120 continuing care locations, such as home care, hospice, senior living facilities, that type of thing. Dr. Roth joining us today from Livonia, Michigan. Beautiful Livonia. Hey, so Dr. Roth, let's start off here with the general idea of what's being approved and how it was being approved. Generally, the FDA process is pretty long. You go through a process to try to determine not only whether the drug works, but whether it's also safe. Based on the speed of which this made it through the system, how confident are you in both of those two metrics?
Thanks, Romaine, and it's great being with you today. We're very confident. We think that the process that the FDA and the CDC has followed really struck the great balance between having a treatment and a vaccine that's available as quickly as possible, given the pace and the impact of the pandemic, as well as making sure it's safe. As we know, they waited 60 days after at least half of the participants had been in the process. And so that's almost 50,000 people between the two studies, making sure that it was safe. And the data that we've seen now, both from Pfizer and then starting today with Moderna, has shown an effectiveness of the vaccines that was really in excess of our expectations. We did not expect to see almost 90% or greater than 90% effectiveness. So on both accounts, we're very comfortable that these vaccines are a great next step and are safe.
Dr. Roth, from a distribution perspective, you're on the ground, you're seeing how this is Pfizer is being disseminated, the vaccine through your hospitals and senior care facilities. You're going to look at Moderna, which arguably is a little bit easier as it needs less freezing temperatures. But from your perspective, compared to other vaccines, how difficult is this to get into people's arms?
It's slightly more difficult, but it's not undoable. We've been preparing for this for months. We've known about the ultra cold chain requirements for Pfizer, and we've been preparing for that. And I think the work that Pfizer has done, and we've been in contact with them, as well as the FDA and the CDC, has made that process that we're going to be able to navigate very well and make this available not just for our own healthcare workers, but for the community. So we're prepared for that. I think we can make it work. It's not as hard as it seems. We just have to be thoughtful about the process, and I think we're very prepared for that. Obviously, the Moderna vaccine does not have that same degree of requirement. That will make it a little bit easier, but I think we're prepared, and we'll make sure that we can get vaccines to people, because this is the beginning of the end of the pandemic, and that's the most important thing.
Dr. Roth, I mentioned at the top of this segment New York and California, where the issue is hospitalization capacity that is really on the brink. How is Trinity Health doing in terms of capacity? Where do your hospitals stand right now?
So it's a difficult time. There's no doubt about that, both across the country and for Trinity Health. And the irony, right, of facing this highest surge yet. So we are at a peak of the number of hospitalized patients with COVID that we've seen yet in the last couple of weeks. We've hit that peak, and that has created a significant strain for us, and in particular our care providers. And so we're managing it, but I will admit it is a significant strain, especially for caregivers who have been going at this for 9 months. And so it does have an impact on our ability to provide services in some locations outside of COVID, which we don't want to do, because we know that it has a broader health impact as well. But we work hard to be able to maintain critical services for everybody. But it is not lost on us that while we're trying to roll out the vaccine, we are facing the highest impact of COVID in all of our communities across the country, and we have more than 2,000 people in our hospitals with COVID today.
So the impact is, by many measures right now, doctors, surpassing what we saw back in the spring, March, April or so. With regards to the preparation and the abilities of healthcare providers to deal with the influx of patients, and more importantly, to keep the death rate down, how much better or worse are we now than we were back in March?
So there are a number of things which are much better today compared to the spring, and that has made it doable because we are, as you point out, at a much higher level of hospitalized patients impacted by COVID today than we were even in April. But we know that that the treatments that have come to the fore over the course of the last few months, as well as our learning and healthcare is learning about how to better care for patients with COVID-19, have made a significant impact. We've seen our mortality rates decrease by more than half on patients who were admitted to the hospital, and our time in the hospital has also been cut by almost half as well. So that has made that burden more doable, and obviously, most importantly, better outcomes for people. And that's not to minimize the impact on these patients and their families, particularly the 3,000 people a day who are passing. But we are in a much better position.
Are you being able to vaccinate your own staff as quickly as you'd wish?
Well, I think we would love to have as many people vaccinated as quickly as possible. It was heartwarming, I will admit, on a personal basis, to see our nurses, ER nurses, and physicians and ICU nurses being vaccinated in a couple of our markets yesterday. And so it's heartwarming for us, and it's been a long time coming, and we know that's the beginning of the end. We obviously want to get this as quickly as possible. We know the process will take a little bit of time this week and over the course of the next few weeks in order for us to get to everybody. But we are ready to go and started even yesterday.
Dr. Roth, would you advocate for locking regions back down as an interim measure until more people can be vaccinated?
I think at this point in time, some of that varies by market, but I think what we have to do is do what we know works. And what we know works is masking, physical distancing, avoiding gatherings, both gatherings in small and large settings, and using hand hygiene. We know that those work. We have to do them as a country. We have to do them together and consistently. We know if we can do that, we think we can really put a dent in the number of cases, especially with the holidays coming up. That becomes a critically important part. So I don't know that we have a position on locking down as much as we want to make sure that everybody is doing those things that we know work, especially wearing masks.
We want to thank you so much for taking some time with us when you've got so much else on your plate. Wonderful to hear some of the heartwarming stories from Dr. Dan Roth, of course, Trinity Health Chief Clinical Officer there. We have breaking news for you. Of course, the ongoing stimulus will they, won't they debate over in Congress. And we currently understand that Mitch McConnell, of course, majority leader of the Senate as it stands, is again suggesting putting off state aid and liability. But he says that they won't leave for the year without a relief package. At the moment, the markets have been trading higher on the hopes of the stimulus deal coming as soon as today. This is Bloomberg.
Time now for a quick check on the latest business flash headlines. Credit Suisse Group signaled that business continued a mixed performance in the fourth quarter. The investment bank is doing well with higher revenue than it was a year ago, but Credit Suisse warns that write-downs and legal provisions will weigh on earnings. It's the latest sign that the U.S. economy is hitting a snag. A growing percentage of American homeowners are looking to delay mortgage payments. In the first week of December, the proportion of mortgage borrowers that started seeking forbearance relief rose to its highest level since August. That's according to the Mortgage Bankers Association, and that could eventually lead to more foreclosures. And the New York area is bracing for what could be the worst December snowstorm in a decade. The National Weather Service says a foot or more of snow could blanket the mid-Atlantic and Northeast starting Wednesday. The storm threatens to snarl road, rail, and air traffic just as trucks carrying Pfizer's COVID-19 vaccine from Michigan fan out nationwide, and carriers are busy with holiday package. The New York City Department of Sanitation has declared a snow alert and suspended outdoor dining on city streets starting at 2 p.m. New York time on Wednesday. And guys, I want to talk more about the snowstorm, because it really gets me in the holiday spirit. I love snow, but also because we have a really cool function to highlight on the Bloomberg terminal. This is Map Weather Go, and it can show you the probability of snow in the Northeast region. Tomorrow, it is above 90%. We could get 12 to 18 inches of snow here in New York. And as I just discussed, maybe a snow day is not that exciting with everyone working from home, but it really could impact some of the critical transportation infrastructure, both in terms of vaccine and everybody trying to get out their Christmas presents, Caroline.
That's such a good point. I'm sad personally to be missing the snow, but I wish that it doesn't impede the vaccine in any way, shape or form. Meanwhile, I'm shining a light on probably what would be one of the most talked about stories if we weren't in the middle of a global pandemic. And it's this unbelievable rampage of, well, cyber hacks that are going on in the US. At the moment, we understand that at least 25 entities have been victims thus far, but there could be up to 18,000. So says SolarWinds, which is, of course, well, the software maker that's seen its solve the vulnerable element here that seems to have been spreading this particular attack? We understand it's the Russians that are behind it, an elite group of Russians, we understand. FarEye first found it, but keep an eye out, Romaine.
You know, Caroline, there's a Fed meeting tomorrow. Kailey, there's a Fed meeting tomorrow as well. Let's hope they don't get snowed in down there at the Eccles building. You take a look at this next chart here. You get some sense here of this idea, this negative rate environment. Everybody was betting on it. Basically, you take a look at that chart and you see that box. It's highlighted there. You're talking about contracts going out to December 2021, March 2022, and June 2022. So 12 months, 15 and 18 months. Back in the summer, everyone said negative rates were what we're going to see. You saw those trades start to get pulled back, reassessed in August, and completely unwound in September. You see where we're at now. Nobody's expecting a negative rate environment, but they are expecting snow.
This is Bloomberg Markets, The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Kailey Leinz.
A little after 2:30 here in New York. Let's get you caught up here right now on settlement of NYMEX crude futures, flirting at one point here with almost $48 a barrel. Of course, there was some actually some negative reports here about demand in 2021 coming out of the IEA, but some of the optimism here surrounding the vaccine providing a little bit of a boost. Gold actually getting a bid here today. Of course, people looking at that additional stimulus. Of course, the idea of lower for longer rates and a weaker dollar, and that continues that bid into gold. Lumber price is interesting. We hit about 845, a record on intraday on lumber futures on this day, something that's pretty rare. You don't see this time of year, but right now, one trader that Bloomberg News spoke to basically said that lumber buyers are basically living hand to mouth at this point, Caroline.
One to keep a close eye on. Meanwhile, we go from commodities, Romaine, over to the world of credit markets, because without a doubt, sure, yields are pushing a bit higher today, but interest rates ultra low right now. Credit investors everywhere anxious to put their money to work. For more on, well, what to expect in the new year, let's bring in Bloomberg's Sonali Bassett with one of the biggest voices in the industry. Sonali.
Thank you, Caroline. And joining me now exclusively is Carlyle's Mark Jenkins, the global head of credit for the $53 billion credit business at Carlyle. Mark, thank you for joining us.
Thank you for having me.
It sure does seem that investors are impatient. They're anxious to get money to work. What are you telling them?
Well, I think what we're recognizing today is, and we spoke back in August, is that we, typically go through, a phase of like survival in credit when there's a dislocation to recovery to prospering. And right now, we've really experienced a lot of those in a very compressed period of time. So what we're telling people now is, for credits that have actually prospered in this environment, and there have been a number of them in the healthcare and tech space, we're looking to just invest in them in a regular way credits as going concerns. There's a lot of opportunities where companies are looking to transition, if you will, to look to the end of this pandemic, which thankfully with the vaccine seems to be coming near to an end, and how we can help those companies get there. And then finally, a lot of people are talking about the distress cycle, which we're not seeing just yet, but we're watching very closely. So it's really looking at all three of those strategies in tandem.
Right. So your colleague, Jason Thomas, had written this report recently, and it really points to the spike in the high yield default rates. It makes the point that we're at historically high levels of indebtedness of corporate America. How are some of these issues concerning you?
Well, I think, as Jason wrote in that paper, that we've got a spike, obviously, in leverage in companies. I think we also, with the low interest rates, are actually at debt service levels that are actually comparable to, sort of more prosperous times, if you will. But I think that the main concern is that we've now got companies who've solved their liquidity issue. And the question is, are they actually solvent? So i.e., is their going concern value going to outweigh the amount of debt indebtedness that they have? And in particular, when we get to the other side of this pandemic, will those capital structures support that new world of growth that we're going to experience for those companies? And I think that's really the focus of that paper, is to say we've dampened, probably for the next 12, 24 months, we've dampened that default cycle, right, but we've really pushed that issue out.
Well, if we push that issue out, there's a lot of talk about the zombification of companies. How are you thinking about that issue?
Yeah, I mean, for us, it's an opportunity to some extent, but also it's also a threat. So when we're investing in transitional companies that we believe when they get to the other end, when they actually when we come out of this pandemic and there is a more sustained recovery, that those capital structures are actually going to work. And that's really transitional capital, helping companies get to the other side with an appropriate capital structure. So there's a lot of those opportunities because some of those companies just don't have access to the regular way capital markets. And then secondly, it's identifying, following, and figuring out how to get involved in these companies that are going to have to go through some sort of restructuring. And so really, again, it's pursuing two strategies in tandem on behalf of our investors. And that's enhanced by the fact that today, really understanding the enterprise value as business models are going to change as we come out of this pandemic, is really leveraging the platform of a broader firm to help understand those business model changes that we're seeing in our broader portfolio today.
As a credit investor, another question that is underpinning the market is inflation. What are your inflation expectations?
Well, I think I'm a credit investor. I'm not a good macro investor, so I won't put my point of view out there. I think what I would say in terms of inflation, what I would worry about as we come out of this pandemic and through into a recovery is there's a lot of pent-up demand, right? There's been so much demand destruction in certain areas. And also there's issues around the globe with global trade agreements or lack thereof, and the type of disruptions that's causing supply chain. So I believe that as we come out of this, I'm more concerned about the bottlenecks and inflationary pressure in certain areas that affect certain industries as opposed to macro inflation. But certainly, over a long period of time, would we expect some inflation? Sure. But I'm more focused on how it affects the underwriting of credit in specific industries.
Well, speaking of specific industries, you pointed to the idea that we might start to see some more distress. How does that start, and when does that start to play out? The Fed has really lifted a lot of tides this year, and I think that idea of distress is something a lot of people are looking to get to work in.
Yeah. Well, if you think about what's happened so far, really 2/3 of the defaults and sort of restructurings that have happened have really occurred in retail and energy. I'm sure you've heard that before. And those were sectors that were having troubles before the pandemic. So it just accelerated that. To your point, a lot of companies have just been, given that liquidity bridge to some point in time. And really it's going to impact companies that can adopt to this new environment where if you look at our anybody's portfolio right now, what you've noticed is the winners have been the ones who've been able to adapt technology to interact with consumers and businesses in a more effective, efficient way. And there's going to be plenty of companies that aren't going to adapt to that. And I think they're going to have capital structures that will require restructuring. Right. And that's where we're going to focus.
So is early next year finally the time for you to start distress investing a bit more?
I think it's still early. What's happened is the ability to enter, like when you distress invest, you have to enter into that either through a company either going through a process or us buying their securities in the secondary market. And the challenge right now is because everybody's been provided with liquidity, prices are high to buy in the secondary, point one. And number two, people have that liquidity line to keep them going. So I actually think, we'll start, I don't want to predict, but it just doesn't feel like, we're going to see a rush of distress in 2021.
Mark, thank you so much for joining us. That was Mark Jenkins, Carlyle's Global Head of Credit. Romaine, back to you.
All right, thanks, Shanali. Coming up here next on this program, Carvana, the shares there at one point today at a record high. We're going to talk about why the online used car seller getting a vote of confidence from some analysts out there. It's our stock of the hour. Coming up next, this is Bloomberg.
Let's talk deals now, because earlier this year, Goldman Sachs appointed new co-heads to lead the bank's M&A unit. Stephan Feldgoise, who has been with the bank since the late 90s, sat down with Bloomberg senior deals reporter Ed Hammond to discuss what the activity he's seeing as a very unusual year wraps up. Take a listen.
2020 was certainly what I'll call a barbell year. The first third of the year was quite active up until the pandemic. In the pandemic, we certainly hit what I'll call an air pocket. But as you say, coming out of the pandemic, it's been an extraordinary level of M&A at the highest levels we have seen. Now, some of that was pent-up demand, but as you look at the fundamental drivers of M&A, so equity markets at significant levels, debt markets and the banks being very willing to lend, those fundamental drivers remain in place. So as you look towards 2021, you feel that the support or the fundamental drivers of M&A remain very strong.
And David Solomon this morning gave an interview saying he was concerned about the euphoria in the market, I think specifically referring to the IPO market. Are you similarly anxious about just the level of activity we're seeing in the M&A market at the moment?
So I certainly wouldn't characterize the M&A markets as euphoric. I think what I'd say is that the fundamental drivers, in addition to what we talked about before about companies thinking differently or more broadly about risk and where M&A should happen, are really the fundamental drivers. I won't comment on the IPO markets, but again, when you look at the fundamental drivers of M&A, CEO confidence, equity markets, debt markets, risk in a different light, in a different lens, all of those remain, I'd say, as fundamental drivers that continue to drive the M&A market.
And in terms of fundamental drivers on the side of the seller, obviously a lot of companies have seen their own valuations crushed and maybe recover less than some of the potential acquirers out there. What does that mean in terms of just the dynamics of some of these conversations? Are we going to see more unsolicited activity, more pure hostile activity, or indeed more activity driven by the sort of activist investor campaigns that we got so used to in the years maybe 15 to 18?
So I think a couple of things I would say. You certainly see more stock deals. So a seller who may not feel that their valuation has achieved what they would like would be willing to take equity in a transaction and participate in the synergies and the upside. You also see significant activity from activists. During the pandemic, activists backed off to a degree as it wasn't as active a period. But certainly now and going forward, activists will continue to push, and we see them being very active in many, many different markets.
In terms of the advisory part of deals, which obviously is where you spent most of your career, talk to me about how that's changed during the pandemic, from the pure physical changes of not actually being in the room with a lot of the people making the decisions to actually the way that the deals are being played out and perhaps around the timeline of getting done.
So the timeline hasn't really been extended in M&A. I think what we found during the pandemic is that we were impressed by the amount of transactions, the number of transactions that were actually able to be done all or nearly virtually all from a virtual perspective. Zoom and other methods of interaction were very effective. And of course, M&A is about relationships, but we found that that was able to be carried on during the pandemic through virtual interactions. And so you certainly saw a lot of activity that carried forward regardless of the pandemic.
Do you think it will ever return to the sort of pre-pandemic world of bankers being on airplanes all the time, flying to and from clients?
I think it'll be somewhere in between. Client meetings, seeing clients, seeing people will still be a very important part of M&A. That being said, certain things like data rooms, which were electronic, certain things like management presentations can be done very effectively over virtual networks, but still there will certainly be a return of getting on an airplane and going to see people and people getting together.
All right, co-head of global M&A over at Goldman Sachs, speaking a little bit earlier with Ed Hammond, our deals report. Let's turn from that now to our stock of the hour. We're talking about Carvana today, getting a vote of confidence over at Truist, which is adding it to its performance. In a year when city dwellers find reasons to buy used cars, Carvana, let's just get to the shares. Right now, up 3% on the day. Dave Wilson joining us right now, talking about a stock, Dave, that's almost tripled already this year. What's going on? How much higher can it go?
That's the real question. It isn't just about this year because the stock more than doubled last year, too. It's up more than 17-fold since the company went public back in April 2017. They sell used cars through these dealerships that they call car vending machines. This year, they shifted and allowed people to buy cars entirely online. Sell them, too. You get them delivered. You get a 7-day return policy. And so even though the company's had this history of losses, analysts not expecting an adjusted profit until the third quarter of 2022, according to our data, the company's just taken off, $40 billion plus market value. And so now you have Truist Securities, Naved Khan, he's an analyst who focuses on the e-commerce business, coming in, giving the stock a buy rating, and setting a 12-month share price estimate of $314. That's the highest projection among 21 analysts in a Bloomberg survey. And among other things, he figures they'll be able to expand their vehicle selection, increase their coverage geographically, deliver faster. People getting more familiar with the brand. Carvana's television advertising is certainly a part of that. He also notes the auto dealership business, kind of a fragmented market. I mean, the top 100 dealers with less than 10% of the total market share, and relatively few vehicles sold online, less than 1% back in 2018. So there's a lot of room for Carvana to grow here, even to the point where he figures it's an $85 billion revenue company in 10 years.
Yeah, everyone out there buying cars. Carvana, our stock of the hour. Dave Wilson bringing us that. Of course, those shares up 3% here on the day. Coming up next here on this program, lawmakers in Washington negotiating another stimulus package that could be passed before year-end, but state and local governments, they fear rising costs and weakening revenue growth into early 2021. This is the moment I've been waiting for. Taylor's gone. Muni moment with Romaine and Caroline. Emily Raimes of Moody's Investor Service joining us after the break. This is Bloomberg. All right, time now for our top calls to look at some of the movers on the back of analyst recommendations. First up, take a look at Marriott, upgraded to buy over at Citigroup alongside its peers, Hilton and Host Hotels. Citi turning bullish on the broader lodging sector and says the space stands at the beginning of a multi-year recovery. Shares up 2.5%. Next up, let's take a look at Redfin. Right now, trading at a record high. The price target being raised to a street high, 73 over at Piper. The analyst says real estate tailwinds could continue into 2021, given the favorable demographics and those economic conditions. See the shares here up 5% on the day. Finally, let's take a look at Tenet Healthcare. Getting an upgrade today to buy over at Deutsche Bank, street high, $69 price target. The analysts citing the recent purchase of Surge Center Development. This is an efficient use of capital, according to the analysts over there, saying it should be immediately accretive to earnings. Shares here up 6% on the day. And Kelly, those are some of our top calls.
All right, Romaine, well, time for the moment you've been waiting for, the Muni moment. A bipartisan group of lawmakers outlining their proposal for a $908 billion stimulus package. But the proposal is split into two parts with a separate bill for aid to state and local governments. Joining us now to discuss is Emily Raimes. She is Vice President and Senior Credit Officer with Moody's Investor Service. Emily, it's great to have you. It's unclear at this point if this will even pass, but the one that seems most likely to pass is the core bill that doesn't include that state and local aid. If that doesn't happen, what kind of additional pressure could that put on state and local budgets?
Sure, and Kailey, thanks so much for having me. We are not expecting another round of federal stimulus in our ratings on state and local governments, our outlook for state and local governments. We're not expecting it. They got one big round already. What we have seen historically is that the federal government has supported state and local governments in downturns. So it is possible they will pass another round. We're not expecting it at this time. I will say that there are a number of state and local governments, the areas that rely a lot on travel and tourism, those areas that are hoping for it.
Certainly hoping for it. When do we start to see the lagged effect? Because it doesn't all happen right at once.
Sure. We're seeing a lot of state and local governments that are having a very challenging economic environment, business conditions, but a number of them, in fact, most of them, their budgets are okay and their revenues are doing okay. And that's because they've gotten that first round of federal assistance, the CARES Act, that really helped them. Most of them budgeted very conservatively for the current fiscal year they're in, and most of them came into this situation very well prepared. They had, a lot of reserves, a lot built up, so they're doing okay for now. Depending on how long this pandemic lasts, how long the recession lasts, we could start to see that revenues start to really take a hit.
Yeah.
That would most likely be in the sort of the areas that are most hit by this pandemic. So that would be sales taxes, hotel taxes, things like that have been the most hit, as well as areas like public transit that have not yet returned. Areas like personal income taxes and property taxes have held up well so far and would probably continue to do so.
Let's zero on one state, and we can maybe talk some examples here real quick, Emily. We'll focus on my home state of Illinois, obviously a bit of a sort of budgetary basket case prior to COVID-19, but it seems like they've actually weathered the storm relatively well, given some of the obligations, particularly on the pension side, that they're still grappling with.
Sure. Illinois is our lowest rated state, and as you said, it's due to that outsized pension obligation. They are looking for some kind of help, some kind of assistance through this so that they can afford those obligations in the future. On November 3rd, we saw voters in the state rejected a constitutional amendment that would have allowed a progressive income tax, which would have provided billions of dollars the state could have used. So the failure of that constitutional amendment means it's probably more likely that the state might borrow money for some of its obligations. On the other hand, states have a lot of powers.
Yeah.
They can increase other taxes. They could do spending cuts, and those things, there are things that could be done without voter approval. So the ability to do those things and the likelihood that they will do those things does kind of mitigate the impact.
Emily, great to have you on. Emily Raimes, Senior Credit Officer, Vice President over at Moody's. All right, let's get a quick check of where we stand here on the broader market. Stocks right now pretty much hovering around the highs of the day. You're looking at S&P 500 reaching for a 1% gain. You're actually seeing the Russell 2000, your small caps, your mid caps as well, up more than 2% here on the day. Commodities also getting a boost. Looking at that rebound in crude. WTI right now trading near $48 a barrel. This is Bloomberg.
We are counting you down to the close. Just 1 hour left in trading. I'm Caroline Hyde.
And look at this. Stocks right now near their highs of the day. I'm Romaine Bostick.
And I'm Kailey Leinz. Taylor Riggs is off today. And at the highs of the day, Romaine, and no surprise when you look beneath the surface, you can see a risk on tone. Almost everything is green. 450 roughly of the stocks in the S&P 500 are higher on the day, and every single sector is as well. What's notable leading the charge is those cyclical trades that were under the most pressure in yesterday's session. You have energy, materials, financials higher. Take a look at that. 100% of the members in those sectors are in the green on the day. And I want to point out utilities as well. That index heading for its best day since November 2nd, and I think that has a lot to do with the snow we're about to get, Romaine.
Yeah, and take a look at some of the individual movers today. Eli Lilly and Prevail, the two big M&A names of the day. Eli Lilly buying Prevail. You see Prevail up 82% on the day, but that move in Eli Lilly, a lot of people really excited about this. It gives Eli Lilly a huge entry into that gene therapy space potentially, not only for the drug that Prevail is developing, but really for a broader array of treatments that could come out of this. A lot of positive news there. Plug Power up here on reports of it having a deal with Walmart, a distribution deal with Walmart, giving the shares as much as 13%. And Nike moving higher on the day. At one point, it was actually at a record high. Don't forget, we get Nike earnings later this week. And I point out Nike today because it's actually the biggest jump in volume today, other than Snowflake. But the volume here right now on Nike, at least as far as large cap stocks go, double the average here. So right now, you're looking at investors positioning ahead of those earnings, which are actually going to come this week, Caroline, on Friday, believe it or not. We'll see how they stack up against Adidas.
You say Adidas, I say Adidas. You say Nike, I say Nike. Meanwhile, I'm going to be looking at what's happening in terms of the stimulus. Everyone is desperately waiting on tenterhooks as to whether will they, won't they, what size of a deal, whether it will go to the state and local municipalities. But notably, people are starting to worry in the market that it might not be big enough. Notably, we were speaking, of course, Bloomberg TV just yesterday with the head of Lazard's advisory business, that being Peter Orzeg. He worries about the size and scope of any sort of deal. Take a listen.
We are bumping up against a real constraint. Eviction rules are scheduled to expire at the end of December. Parts of the additional unemployment benefits that were provided as part of the CARES Act scheduled to expire at the end of December. State and local governments facing 15% declines in revenue for their next fiscal year. There will be more pain coming unless we act aggressively.
Businesses hurting, people hurting, many hoping that those paychecks and any sort of support can come through quickly, certainly to support the economy, remain to support the markets too.
Yeah, let's talk a little bit more about that and bring in George Bory. He's head of fixed income strategy and portfolio specialist at Wells Fargo Asset Management. George, great to have you here on this day. Let's first talk about the short-term news of the day. The Fed, of course, going to make an announcement tomorrow. The expectations a bit mixed here in the market. Any sense here that what the Fed either does or what they telegraphs tomorrow could have any sort of ramifications right now for how traders are positioned?
Yeah, sure. Good afternoon, Romaine. Thanks for having me on the show. As you point out, if you look at the fixed income markets, the bond market, we're basically in a pause mode waiting for the Fed. And the Fed this is going to be an important meeting, an important announcement. And we think it could really break one of three ways. They could try and preserve their optionality, which means they don't give the market any new information. And they basically just sort of state where we are and say that they're willing to react depending on how the economy evolves. That probably leads to higher interest rates. It's the Fed not guiding interest rates lower, not providing additional stimulus, not providing additional clarity as it relates to the trajectory of yields. In that scenario, yields go higher. The other alternative is they sort of commit themselves or become very clear about their forward expectations. Where do they expect to be 12 and 24 months out? Now, in that scenario, that probably keeps yields pretty stable, but the curve could probably steepen a bit there as the front end stays anchored, but the long end maybe kind of continues to rise a bit. And then the last is, and I think this is where a lot of folks are kind of hanging their hat and hoping for some clarity, that the Fed provides guidance with respect to yield curve control. We don't believe that they're going to be explicit about yield curve control. They may include that as a potential strategy. We don't think we're going to get a lot of clarity there. But if they were to provide that clarity, that would actually cause yields to come down and perhaps the curve to even flatten. So this is going to set the stage for at least the beginning of next year and perhaps a large percentage of next year. We think your best bet right now is that the Fed just basically extends out some of that forward guidance and tries to preserve as much optionality as possible.
So within all those scenarios, within the optionality that the Fed wants to buy itself, what's the optionality for an investor? Do you stay committed to sovereign debt? Do you go lower down into higher yielding sorts of parts of the market?
I think there's a very good chance of a cyclical recovery, or we think there's a very good chance of a cyclical recovery. We were talking about that earlier on the show. And if you just look at the equity market, obviously the equity market's doing great. Cyclical names are doing quite well. We're seeing a recovery in the oil sector. In fixed income, it's harder to play just a pure cyclical recovery. You have really kind of two components. One is just a simple fundamental strategy. And here we're strongly advocating that clients be willing to go down in credit rating, go down into high yield, go down into the lower rating parts of the credit markets, and really trying to position yourself for that cyclical recovery. Energy as a sector is largely represented in the high yield market. And so you can almost make a soft bet on energy simply by buying high yield. And we would certainly advocate that. We think energy is going to do well next year. The other is just simply the shape of the yield curve. And as we've seen up until very recently, the yield curve has been steepening. And so we've been trying to pull that bias down the yield curve, try and stay invested towards the front end of the curve, letting longer term yields kind of shake out. We want to be kind of neutral duration sort of overall. So that would be kind of our highest conviction view, if you will, short duration, short maturity, high yield, that lower maturity profile, but a lower rating, a much higher yield, say 3.5%, maybe as high as 4%, looks pretty good going into next year, especially if we get that cyclical recovery that kind of helps the fundamentals of those companies kind of improve as we go into next year.
Well, George, continuing to look ahead into next year, this year we have seen record corporate issuance, volume something like 32% above the previous record from back in 2017. Does that appetite, that demand continue?
We think that demand remains pretty robust for fixed income in general. Although yields are likely to go up modestly, they're still likely to stay low by historical standards. A 10-year yield at, let's say, 1.5%, which is where we think we could get to by the end of next year, is still very, very low by historical standards. The other is that if we look at the U.S. versus the rest of the world, right now the U.S. makes up 90% of all positive yielding debt in the world. That's a tremendous statistic, and that other investors from around the world continue to come into the U.S. So we see a good reason why investors are going to continue to stick with high yield. It's still the corner of the portfolio, the anchor, the cornerstone. It's a big part of your portfolio. The incremental yield is absolutely critical, and we don't see clients or investors giving up on that. And I think that's going to be sort of a really strong theme. Now, as it relates to the amount of money that companies need to issue is probably going to drop down to a more kind of what we would call typical year, where you're maybe at $1 trillion or 1.2 trillion for, say, investment grade debt, maybe about 200 billion for high yield. So let's just call it maybe 1.5 trillion, which is materially lower than this year, so may show some degree of a technical squeeze, but is much more in line with what we've seen over the prior 3, 4, 5 years before 2020.
The supply-demand debate. George Bory sticking. We thank you very much indeed, Head of Fixed Income Strategy and Portfolio Specialists at Wells Fargo Asset Management. Great to have some thoughts with you today. Now, coming up, China heads for a recovery, while the country is on pace for strong growth next year, even though, well, it still has a long way to go. Meanwhile, a sharp blade after a huge week of IPOs. We look at the company that's going public via a SPAC. Another one. We speak with the CEO and co-founder, Rob Wiesenthal, on what impacted his decision. And keep wishing why online dollar store Wish is losing momentum just as it files for an IPO. All that and so much more coming up. This is Bloomberg.
All right, welcome back to Bloomberg Markets. To close 46 minutes, counting you down to the close. Let's take a look at where stocks stand. Right now, you're looking at the S&P 500 right near the highs of the day. The Russell 2000 small caps outperforming, 7th day in the past 10 sessions. Keep an eye on that cyclical trade. Dollar weakness. You flip up the board, you take a look at some of the individual movers. Apple shares on fire today, up 4%. Biggest one-day move that we've seen for 2 months now is that report out of Nikkei Asia about production. Seemed to be relatively bullish on iPhone production. You're seeing the suppliers, Qorvo, Cirrus Logic, Skyworks, all of them, all moving higher. AMD, not an Apple supplier, but moving higher at a record high right now. Larger bullish sentiment out there right now on the chip sector, particularly for companies that make those graphics chips used in video games, Caroline.
So on the heartbeat across the markets, we're keeping an eye also on what Charles Lee is doing as he's leaving office after 10 years as Chief Executive of Hong Kong Exchanges and Clearing. He spoke with Bloomberg's Sophie Camarudin about the future of Hong Kong relationship with the mainland. Take a listen.
The Chinese market will never be like the international market in its entirety. The international market will never be able to suit into a Chinese market, but there will be enough, middle ground where they do intersect. It is in that intersection that Hong Kong have to find the most relevant role to play, because Shanghai will play in that role, Singapore will play in their role, other people will play in their role, but Hong Kong is the only one who can truly go in between and need to find a way, because that role initially is small, becoming bigger and bigger, and then eventually stabilize so that the American will still be here, the Chinese will be here, there will be something in the middle. Then when that middle size is no longer growing, then Hong Kong just need to go deeper.
Now, there was momentum towards embracing Chinese assets. We've seen index compilers, for example, including those equities on their indices. That has stalled somewhat given the U.S. sanctions imposed by the Trump administration. What are the implications of that on China's attempts to integrate into the global markets and its liberalization on the mainland, as well as Hong Kong's role in this?
If you look at that global map, invariably you will walk away with the conclusion that China is the place where yield is going to be, because fundamental economic development is stronger there. The consumer class is growing there. The people are getting more wealthy. The currency is becoming stronger, and their supply chain is as resilient, as strong as ever. While this decoupling will continue to put stress on the respective economies of each other, I think relatively speaking, the Chinese market will become increasingly more important for global investors. So yeah, government, policy makers, individual political figures can always do whatever they wanted to do that could potentially create short-term temporary impact on a more localized target. But as I said, finance money is like a water. You can't block water. You can block water from one area. You can't block water all the time. Water is going to sip through it. If you block it, it's going to sip through it. It's going to go up to the sky, and then it's going to rain into the other side. They will find a way to get there. You can't really block it. It's not very easy to push water uphill.
And what are your thoughts on banks complying with
Hong
US
Kong
sanctions?
Exchange's outgoing chief executive, Charles Lee. All right, time now for Options Insight with Abigail Doolittle, where, Abigail, you're starting out with credit ETFs.
Indeed we are, Kailey. Thanks so much. And joining us today is Chris Murphy of Susquehanna. And Chris, you know, you're making a very interesting point here that everything basically is going higher, at least today, breaking a bit of a losing streak, in fact, for the S&P 500. But credit, not so much. What do you see happening here?
Yeah, so hey, Abigail. So fixed income ETFs have had massive inflows this year. You're talking HYG, LQD, et cetera. However, there are some signs that's reversing this month. Last week, LQD had $2.2 billion in outflows. That's the largest weekly outflow in 27 weeks. HYG saw outflows of $430 million yesterday and hasn't seen a day with inflows since December 3rd, losing $2.7 billion over that time. On top of that, we've seen an increased amount of hedging in LQD, HYG, JNK, et cetera. We highlighted that last week, and then even today, a buyer of 10,000 each of the March 77.84 and 78.83 put spreads in the HYG. Why the put spreads? Well, put skew is really high in these fixed income products, and that's part of the reason we've been recommending these put spreads. We've even also been highlighting put spread collars. They set up attractively due to these same option wings, these out-of-the-money calls and puts being bid up compared to the at-the-money, and a high downside max payout compared to premium spent. Particularly like those put spread collars because they take advantage of the skew but also short the call above all-time highs, and it's just hard to see much upside past all-time highs given how tight spreads are and how low rates currently are. So what's the trade? This morning we looked at the LQD March 135, 128 put spread versus selling the March 141 calls, set up for only 0.5% of spot cost with a max payout of close to 6 times outlay. 141 is well above the all-time highs from earlier this year.
And that is certainly some trend week after week of outflows for HYG, something to keep in mind. And IPOs, all of these hot mega IPOs, Doordash and Airbnb last week. Doordash options started trading today, Airbnb options tomorrow. What are you seeing there?
First off, where did they set the volatility? It's around 80%, 2 or 3 months out. That's similar to Tesla, in fact, even a little bit higher. That's going to give you implied one standard deviation move of 5%, so move at least 5% one every 3 days, and move at least 10% one time a month. Early on, we're seeing more puts trading than the calls. This might be due to investors who are long the IPO looking to hedge significant gains that they've had so far. It could also be out-of-the-money put sellers who didn't get in on the IPO looking to sell puts to get in position to buy a dip.
So we'll have to wait for some more data, some more trading action over the next several weeks to see whether or not that options trading cools down a little bit. But right now, it certainly looks like there could be lots of volatility ahead for Doordash and Airbnb, similar to Tesla. Chris Murphy of Susquehanna, thanks so much for joining us for Options Insight. And from New York, this is Bloomberg.
Bank of America's fund manager survey for December came out this morning, and it showed investors have the highest allocation toward EM equities since all the way back in November of 2010. But not all emerging markets have benefited from this trend. Actually, Middle Eastern stocks have lagged far behind. Saudi stocks, as we can see, they're only up 3% on the year. In Dubai, in Bahrain, and the Emirates, they have all lagged the gains we've seen in the broader emerging markets index, which is up about 12% over the past 12 months or so. The question is, does the recovery in oil prices, does the rollout of the vaccine fundamentally change the narrative for Middle Eastern stocks? Well, for more of the latest on all of the emerging action, joining us now is Daybreak Asia anchor Sherry An. Sherry, what are analysts saying about the prospects for Middle Eastern equities?
Things may be looking up, especially as you mentioned, we had a vaccine rollout. Many of these countries have already secured vaccines, either from Pfizer or BioNTech or China's backed Sinopharm. So United Securities now seeing momentum in the UAE, Qatar, as well as Saudi Arabia, saying that there's more active foreign money invested in those markets. When it comes to the UAE, it offers attractive valuations as well. Although Telemer is saying that perhaps Gulf countries could be missing out in the rebound in tourism, given that they're not that geared towards tourists. Still, markets like Dubai and Egypt could be favored. MUFG Bank saying that they're very, very bullish on oil, so they remain very positive on the sectors in emerging markets in the Middle East going into 2021, especially in those cyclically sensitive markets like the UAE.
Let's move more global. What about India? I'm hearing some strong recommendations there.
Yeah, India is already a market that has rallied substantially this year, right? We're talking about an 11% gain year to date for the Sensex. We have seen foreign investors pouring money into the Indian markets, about $20 billion. That would be the biggest amount since any year since 2012. BNP Paribas, very bullish on Indian stocks. It puts a target for the Sensex for next year, 50,500, which would be a gain of about 10% from current levels. And they're saying that Indian stocks are getting bigger. That's a good thing. And also they're seeing more availability of quality stocks. So they like those consumer stocks, private banks, and insurance companies as well.
All right, you're going to talk about that data out of Asia or not, Sherry?
Yeah, because that's really what's supporting sentiment across the region, right? Chinese eco data look pretty good. November activity data, retail sales, industrial production, fixed asset investment, all coming great, as you can see on this GTV chart on the Bloomberg. And of course, this having to do with export growth, consumer spending during Singles Day last month, accounting for e-commerce taking up about 25% of those retail sales. Goldman Sachs now upgrading the Chinese economy and growth to 2.4% from 2%. And tonight, do watch out for those eco numbers coming out of Japan, trade balance, also the jobless rate out of South Korea.
All right, Sherry Ann, we'll definitely be tuning in for that. Sherry Ann, of course, the host of Bloomberg Daybreak Australia and Daybreak Asia. All right, let's turn that back now to the U.S. Take a look. S&P 500 right now up near that 3,700 level. You take a look at the Russell 2000 outperforming the S&P here. Seventh time we've seen this in 10 sessions here. The NASDAQ composite also is higher on the day. You're seeing persistent dollar weakness here, heavy dollar weakness here, of course. The Fed, of course, assembling the FOMC down at the Eccles building in Washington, D.C. We'll get that announcement tomorrow. Commodities continue their rally. We'll be back in a moment from New York and London. This is Bloomberg.
Just about half an hour left in the trading day. This is Countdown to the Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Kailey Leinz in for Taylor Riggs. Well, it is a risk-on day. There is a lot of green on my screen right here. Every single sector in the S&P 500 is higher on the day, Romaine, and it's the reflation trade really leading the charge. Financial stocks, some of the biggest point contributors to the S&P 500, stocks like JP Morgan, Bank of America. You also have materials and energy higher. Topping the pack, though, utilities on pace for its best day since November. We could get 12 to 18 inches of snow here in New York tomorrow. Romaine, not sure if you've heard that yet, but maybe we're going to need to crank up the heat.
Yeah, really preparing for that snow. Let's take a look at some of the individual movers. Fannie Mae and Freddie Mac taking a leg down. This after that Wall Street Journal story basically said that Steve Mnuchin said he's not going to do anything to release these companies from government control during the final weeks here of the Trump administration. This is going to be up to Biden. The market betting that's not going to happen anytime soon. AGCO getting a leg up. The analysts there out raising this stock, basically saying that if you're looking for a good rebound play, a recovery play, an economic recovery play, machinery stocks are it, and specifically singled out AGCO. Had a similar thesis here from another analyst on the Real, also saying this could be an interesting rebound play. Of course, the consignment clothes company and Camping World. Keep an eye on this company. Of course, the retailer of RVs and motor homes. The CEO said he's going to have a press conference at 4 p.m. today with the CEO of Lordstown Motors, the developer, of course, of those EV vehicles. They didn't say specifically what it's about, but you put two and two together, you can figure out. Investors like what they see. Those shares, Caroline, up 11%.
And Romaine, it's interesting, Kailey, talking about the risk-on mood today. Well, interestingly, the latest high-flying IPOs, Airbnb, Doordash, they're on the downside today. So too are some of the IPO indices that we track, the Renaissance one, for example, and indeed the SPAC index that we look at. But despite this, just look at how far we have come in these particular areas of the market that have so outperformed amid the pandemic. I look at what the special purpose acquisition company Indices have been telling us. I mean, it's phenomenal, run up some 40% over the course of this year. We see the IPO index doing even better than that, far surpassing where the S&P 500 has come. And that's when the S&P 500 has done pretty well too. So it's notable, all of this, but the individual IPOs and SPACs are still coming through, and we're going to speak to one of them now. Air charter company Blade will go public via a reverse merger with a KSL Capital-sponsored blank check company. For more on the decision to go public via the all-so-hot SPAC route, we're joined by Rob Wiesenthal, CEO and co-founder of Blade Urban Air Mobility. We know your choppers, we know your helicopters, charter flights. Rob, did you always plan to go public? Is this opportunistic, or is this something that was always in the grand plan?
I mean, truly, ground mobility has totally been transformed by battery technology and software. And you can see it by the SPACs that you're talking about in terms of everything from ground charging stations across networks and actually electric vehicles themselves. They've transformed ground mobility, and the next battle is clearly in the air. And there's never been an opportunity to invest in something specifically geared towards this. We've been building infrastructure and technology from consumer to cockpit over the past 6 years, a customer experience, a trusted brand, 200,000 flyers. We've done it under an asset-light model, using conventional helicopters so that at some point, some people say 2022 or 2023, our model's 2025, we'll be able to use this entire stack to swap out helicopters for what we call eVTOL, electric vertical takeoff or landing aircraft that are both, emit no carbons, are quiet, and more cost effective.
All right, so talk a little bit more about that asset model. Of course, Caroline and I, we get the company official Sikorsky into work every morning, so our eco blueprint is a little bit worse than that. I am curious as to whether the structure of this business is dependent on keeping, I guess, the asset light model, or whether maybe you do get to a point where you feel it might be more beneficial to have a little bit more asset control.
I don't think that's necessary. And in fact, one of the best ways of looking at Blade is that, we are in a way, an index play on eVTOL. So you have manufacturers pouring billions of dollars into individual aircraft. We don't know who the winner is going to be. This allows us to pick the right equipment for the mission, whether it be a short mission. We do a lot of organ movements. We're the largest mover of organs in the Northeast with Blade Metamobility. We have long distance missions. So even right now, we use a variety of different types of helicopters depending on what the proper mission is. And with respect to eVTOL, we'll be able to help pick and choose what makes sense for us and be able to, once the winners have been identified, use them and not be stuck with one particular type of aircraft. If we went asset heavy, not only would reduce our return on assets, but it would reduce our overall flexibility.
So with all this in mind, Rob, what are you expecting for your business going forward into 2021 with a vaccine rolling out? And how have you seen it change over the course of the pandemic, especially in regard to your clientele?
Well, not unlike many other businesses, the pandemic's impacted us in ways that we really did not expect. And in fact, in October, our revenues and number of flights are up versus October last year before the pandemic. People have actually created, and Bloomberg actually wrote this in online, synthetic suburbs. They're taking homes that may have been secondary homes that are no co-primary homes that could be up to 90 miles away. And they are commuting maybe once a week for 2 nights, every other week, as opposed to every single day. But it's really enabling them to live outside the normal sphere of where they used to live in the city. And what's been interesting about that is that it has improved their economics because they're no longer kind of flying out on a weekend where the actual helicopters to go empty, or flying back on a Sunday. We're filled in both directions and we're flying 7 days a week, albeit probably not at the volume we had before. Additionally, our forecast did not assume any type of vaccine, which clearly is not only coming, but we believe there's a lot of pent-up demand for travel, and there are a lot of people who want to get back to work.
Rob, we've got 1 minute. The exact first use case of the funds you're currently raising?
The terms of the funds that we're raising, the SPAC that we're merging into is $275 million in terms of cash and trust, and we raised a PIPE of committed common capital of $125 million from terrific investors like H.G. Vora and Hedosvia, David Geffen, Barry Diller, and David Zaslav, certain original investors, which is committed capital. This will go to purchase infrastructure such as heliports, landing zones that can not only be used today, where we can enjoy better economics, but also can be used for eVTOL in the future and using legacy aviation metrics. So it's a great way for us to bulk up, improve our business today, but also prepare for eVTOL tomorrow.
Rob, we really appreciate you coming on, talking about this. Of course, at least those of us in New York, very familiar with the Blade copters out there, over there on the west side. Rob Wiesenthal, he's a co-founder and CEO of Blade. Blade looking to come public to the markets. We'll be back in a moment. From New York and London, this is Bloomberg. All right, welcome back to Bloomberg Markets. The close about 15 minutes ago until the close. Keeping an eye right now on snow. Abigail Doolittle here with the weather report.
I don't know about a weather report, Romaine, but I love your enthusiasm for snow, and I have to say I'm looking forward to myself. As for our stock of the hour, that is Snowflake, because shares are now down for a third day in a row. The worst 3 days since this stock IPO'd back on September 15th, down about 13%. Today, coming off the lows, at the lows, down about 8%. This, of course, as shares have come up off of expiration around that IPO. So you have a flood of supply. Initially, it hit the stock, now coming off a little bit. But since that IPO, my gosh, let's take a look at the gains since the IPO, because this stock is up nearly 200%. At the highs before the recent selling, this stock had actually been up closer to 3 times from its IPO price. So investors want in on these big software, these big tech IPOs this year. Everybody wondering whether or not the frenzy is sustainable. So it makes sense that we do have a short interest, a pretty significant short interest for a lot of these names, Snowflake included. But Snowflake doesn't have the worst short interest. Take a look at Rocket, the 27% bearish short interest. That means that there's lots of bears out there who think that these stocks will not hold their gains. Good RX, and then Snowflake's right there in the middle, 21%. Unity, 14%. Anything above 5% is suspect. So many traders out there seem to think that these stocks, that these big gains may not last. And then finally, it's going to be interesting to see whether analysts follow through, because relative to a number of the big IPOs recently, we are looking at 9 buys, 12 holds. So most analysts, most experts on these stocks are on the sidelines. Sell, 1 sell.
All right, Abigail, thanks very much. It begs the question, what's going to happen with Wish, another possible billion-dollar-plus IPO that prices tonight? Stay with us. This is Bloomberg.
This is Countdown to the Close. I'm Caroline Hyde.
I'm Kailey Leinz.
I'm Romaine Bostick.
And the hopes, the prayers on stimulus sends us higher across the board. Check out the benchmark indices today. Your star performer, the outperformer in the blue, of course, is your small caps. Once again, overcoming and overwhelming where we see the performance in the S&P 500. But really, all the indices pretty much on fire today. The risk on mood taking us up by more than a percentage point on the S&P, currently up 1.2%, so about 43 points higher. But we're pretty much rising across the board. Every industry group has been in the green today, Romaine.
Yeah, although you're seeing a little bit of a lag here in tech, and you're seeing a little bit of lag in discretionary. What's not lagging, energy stocks, pretty much on fire. That trade, remember, gained a lot of traction last week, lost some ground yesterday, gaining it back today. Halliburton up almost 6% on the day. Hess up almost 4%. The paper and packaging stocks also moving higher here on some relatively encouraging data with regards to container boards, all that stuff. People are buying there online. So you're seeing WestRock get a bit higher, up about 3%. International Paper, Sealed Air also moving higher as well. The Philadelphia Semiconductor Index also regaining some ground here. Biotechs, which of course had been on fire, taking a little bit of a breather today, down fractionally, Kailey.
All right, well, let's get some more market analysis now. We're joined by Angela Mwanza. She is a private wealth advisor and senior portfolio manager over at UBS. Angela, I want to ask you about the level of bullishness out there right now. Bank of America put out its fund manager survey earlier this morning for December, showed investors are most optimistic on risk since back in 2011, and cash allocation is down to 4%. They say that level of cash allocation, which is the first time it's been underweight in over a decade, means it's a sell signal. Does that concern you?
That's interesting. We're not seeing, we're actually talking to people about, not sitting on the sidelines with cash. So a little bit of the opposite. And the concern there is that, we have negative yields. You're not earning anything on that cash. It's hard to time when you're going to get that cash back into the market. And generally, equities outperform most of the time. And as long-term investors, and if you look at a 20-year time horizon, 100% of the time your equities will outperform. We too are risk on. And we too think that there's good upside and good reason to be upside in the market, but we are mindful of certain risks out there.
Certain risks, such as whether or not we get a fiscal deal, what the Fed says later this week. Focus on the first one for us, Angela, the here and the now. How much is already priced in terms of the size, the scope of a fiscal stimulus coming from the US?
I think the reason why you're seeing markets rally again is because there is a lot of optimism around a fiscal stimulus, which I think is good news. That should be our bridge over until there's more widespread access to the vaccine. And I don't think we necessarily have to, when you have the balance sheet ballooning a little bit more, government deficits already at an all-time high. We already saw the Fed doing asset purchases of $3 trillion. So there could be concern that there might be inflation on the horizon, which generally would mean we'd start seeing interest rates rise, which I think is probably the biggest trigger of recessions historically. We don't think that's necessarily the case because that stimulus is something that's necessary to make up for slack in the economy, particularly around labor and commodities. And so in a case like that, high inflation would be really, really difficult to achieve. And so we are also pro-cyclical. We think we definitely do have a reopening trade in the intermediate and long term, and it's just in the short term where we'll see things a little bit more bumpy.
The inflation argument, Angela, for those that believe it is around the corner, always seemed tenuous to me. And I am curious as to when you hear certain members of the Fed sort of raise concerns about it, and obviously they're talking much more longer term. I mean, what would sort of be, I guess, the lead on that? Because through all of what we've seen through the bull market of the previous bull market we've been through, and even through the relative boom that we've had, at least in some areas of the economy this year, you just haven't seen that reflected dramatically in consumer prices or in producer prices.
That's very true. That's very true, Romaine. And I think, when it comes to looking at this reflation, the economic growth that's pointing towards higher inflation, I don't know that there's necessarily those signals. Specifically, the Fed, just in summer, we went from looking towards a 2% target, looking at current rates, to a 2% inflation rate target over a period of time with deliberate vagueness around what over a period of time means, because they are looking at the fact that if inflation starts peaking, they don't want to have their hand forced into raising rates when they don't think that the economy is standing on its own 2 feet yet. That being said, for portfolios, we do like Treasury inflation protected securities, TIPS. We think they make sense. If you look over a 10-year time horizon, if you think inflation is going to be higher than the break-even rate where it is now, it makes sense to hold TIPS. So a nice inflation hedge as part of the portfolio, and we could consider throwing in a little gold while we're at it.
Yeah, 10-year break-even right now that sits at about 1.92. Of course, we were down at about 55 basis points back in March. We're speaking here with Angela Mwanza of UBS. We're going to get back to her in a moment. Counting you down to the close 5 minutes ago. Abigail Doolittle, where do we stand in the markets?
Well, Romaine, we certainly have a rally on our hands. In fact, the S&P 500 up for the first time in 5 days, up 1.2%, the best day in about 3 weeks. And you were mentioning earlier the breadth from sector perspective. Take a look at this. Energy up 1.7%. We also have the financials up 1.5%. So those reflation sectors, the reopening rotation, that part of the trade is on. But so too is tech. Take a look at Apple, up 4.9% on that report from Nikkei that they may be planning to up their production by 30% for iPhones. That's bringing the entire complex higher. Take a look at Skyworks, up 3.7%. However, it's not all rosy, because if we take a look at the VIX in a range, we've looked at this chart before in the Bloomberg terminal, we see the VIX has been trading between about 20 and 40 over the last 6 months or so. Right now, rounding off the bottom, the RSI is rising. It may just suggest that you could see that VIX go back to 40. Leading the way, possibly, Romaine, very interesting. We have both Moderna and Pfizer, the vaccine-related stocks, down on the day. Some sell the news action here. Will this lead the markets lower in the days, weeks ahead? It's hard to know, Romaine, but right now we certainly have some bearish action, and it may suggest that there could be a little bit of cooling off at some point for the broader markets, Romaine.
All right, Caroline?
It's interesting. I'll pick it up from here, Abigail, that perhaps an awful lot of this is priced in when we look at the vaccine companies and how far they've traveled so far, the phenomenal rally that we've seen in the likes of Moderna over the course of the year. I'm going to take it back, of course, to Angela, because Mwanza, who's with us. Angela, your perspective, I'm seeing record highs again being reached for the Russell 2000. I'm seeing a record high for global stocks on the MSCI All Country World Index. I'm seeing a record high on the NASDAQ as well. Are you questioning, at the moment, valuations?
That's a great question, and it's a question that we're answering clients on quite often. But if you look back to March, where we were and where we are today, we're sort of a year into a new business cycle. And business cycles historically, if you go way back in time to sort of the 50s, business cycles are probably around 6 years, post 80s closer to 8 years. So we feel that we're the beginning of a cycle, and we're in a period of growth where more companies are asset light, more companies are nimble, and more companies, even within the S&P 500, tend to carry those higher valuations. So I feel that, yes, we have run up a long way, but given all of the tailwinds, whether it's the stimulus, whether it's the vaccine, whether it's a new administration coming in, I think that it's still supportive of the markets, still supportive of the levels that we see today.
Speaking of valuations or the value trade, are there any areas within value that you still would avoid here? What about energy, for example?
Energy. I mean, energy's had a nice little run up over here. The challenge with energy, I think there's two areas. One on the short term is looking at demand. If we keep seeing economies get shut down, various cities, New York is about to be on lockdown, Germany's kicking into lockdown tomorrow, especially with these longer term lockdowns, I think that doesn't bode well for energy. And then I think structurally over the long term, this move into renewables, just this week is basically the week where we have the 5th year anniversary of the Paris Climate Agreement, and there was just a meeting of 70 national leaders having a crisis meeting, or you could call it, kind of the climate ambition, saying we are not reaching the targets that we made of 1.5 to 2 degrees Celsius of average global warming, maintaining that level. We're not going to get there with all of those commitments we made, so we really need to ratchet up, which speaks for renewable, for battery, and that means governments are going to be spending, providing subsidies, and also regulation behind it. And we're hearing that from President-elect Biden too, which I think is going to be a bit challenging for energy stocks.
All right, we're speaking here with Angela Mwanza, private wealth advisor, senior portfolio manager at UBS. She's sticking with us. You're getting the closing bells here in the U.S. The Dow Jones Industrial Average, the S&P 500, and the NASDAQ each up about 1%. We should point out, again, we don't have it on the board. We should start putting it on the board because it really has been the star of the show. The Russell 2000, 2.4%, not only outperforming the broader market here, but that's a record high, another record high, Kailey and Caroline, for the Russell 2000.
Another record high for the NASDAQ, another record high for global stocks. And I take you cross-asset now, Romaine, to see this risk-on flow through various asset classes. Look at your GMM function on the Bloomberg if you're lucky enough to have it. Global macro movers. I'm seeing the dollar down significantly, once again off by 0.4%. We're at basically a 2-year low as we look towards fiscal stimulus, as we look towards the Federal Reserve and its meeting already upon us. And therefore, the outperformance of the Great British Pound, of course, hopes, prayers still on a Brexit deal. But we're seeing some of the commodity-sensitive currencies doing well, the Canadian dollar doing well, Norwegian kroner as well, even the Japanese yen, usually a risk-off kind of trade, doing well. I'm also looking across the commodity spectrum, steel up 1.7%. Remember, this isn't just about US stimulus. We saw very good Chinese data once again, just showing that recovery, it's solid, Kailey.
Yeah, risk on, Caroline. But of course, that doesn't bode particularly well for the safe haven that is Treasuries. The moves, though, today, not very large. The U.S. 10-year yield up just around a basis point, 90 basis points where we sit. A little bit more movement toward the longer end of the curve. The 30-year yield now sitting at 165.15. But still, 10-year yield below that 1% threshold. The question now is, does the Fed change anything about that, depending on what it gives us tomorrow? Still with us, of course, is Angela Mwanza from over at UBS. Angela, there's some talk that if the Fed doesn't give the market what it's expecting tomorrow, that yields could move pretty materially above 1%. What would a move like that do to your view on equities?
I don't know that it'll specifically change our view on equities. That's still a historically low level for the 10-year Treasury, but we do watch it closely. Where it is a big challenge is specifically around our bond portfolios, because in a diversified portfolio, historically, we would look to our bonds for our safety and for some added yield and for some diversification. And in a low interest rate environment like we are here, it's challenging all of that. So for us, we're looking to see where can we pick up some yield, where can we add to our portfolios, whether it's looking in private debt or looking in areas that are taking on a little bit more credit risk, but not as much risk as going to equities, because it's so tempting to jump into the equity jump on this equity bandwagon with all of your portfolio, because that seems to be the one thing that has worked. But we do like private debt, we like emerging market US dollar denominated sovereign debt, we like some corporates as well.
And when you're talking about an alternative specifically, Angela, to sovereign bonds, to those sovereign yields, which of course are hovering near zero or below zero, and by some expectations are going to go higher, is there a sense here that the balance between the rise in yields that we may get and the returns that you're getting on some of those alternative investments, that may sort of equal out at some point in the future?
It's yet to see. I mean, I think it's easy within the private markets to be a lot more opportunistic, to be a little bit more creative, whether it's looking at royalty streams, whether it's looking at bridge financing. So I don't know that it necessarily will impact each other, but if yields go up to a decent level, then why would I deal with the illiquidity that you get within private equity? We're also seeing a lot of evolution within that space, where it's providing closer, not such large lockups, more liquidity, and yet still higher yield. So it is a space that I think still has a lot of potential for our portfolios.
Angela, what are your clients asking you that we haven't asked you yet? What are we missing? What's the market not talking about that you're getting questions on?
You know, and maybe this is because it's one of my favorite areas. We tend to speak a lot about sustainable investing, about those companies that are looking at environmental, social, governance investments, whether it's looking at mitigation, whether it's looking at integration, divesting of fossil fuels, all of these kinds of investments that are reflective of our clients' values. That's what we spend a lot of time talking about, because when we're thinking about generational wealth, it's not just how is my portfolio going to do in this generation, but how will it do in the coming generations? And not only do I want to ensure that I'm getting a financial return, I want to make sure that my actions today have a positive impact on the future. So that's a really big topic that we spend a lot of time with our families talking about. And there are lots of opportunities, knowing that we've got all of these governments and corporations committing to net neutrality by 2050. Sometimes earlier in some cases, which provides that tailwind for a lot of these investments, whether it's in green tech, whether it's in sustainable agriculture, whether it's in renewable energy, smart mobility. I think that's a great investment to think about if you consider family values, and it's a great investment to think about if you're just looking at the financial return of your portfolio.
ESG still hot. Angela Mwanza, we thank you, private wealth advisor and senior portfolio manager at UBS. We love you riding the close with us. Now, more markets coverage coming right up for you on Bloomberg Markets to Close. We're going to be digging into, of course, the all-important FOMC rate decision that comes tomorrow. What to expect. This is Bloomberg. Let's get you up to speed with where we closed. Higher across the board. Nearly every index, basically all the major indices, above more than a percentage point growth we saw on the day. And record highs once again being hit by the NASDAQ, but also by small caps. It really speaks to the fact that people are still plowing into tech, but they're still plowing, of course, into the more cyclical trades. Kailey.
All right, Caroline, I just want to bring you some breaking news from Microsoft, of course, following on that big story from yesterday in regard to the cyber hack. A lot of fingers pointed at Russia using a backdoor in SolarWinds technology update to affect many government agencies across the board, including the Department of Homeland Security, the Treasury, the Commerce Department. Now Microsoft saying that it is ensuring customers are protected. They have a tool to block the known malicious SolarWinds binaries, and that they have been in communication with SolarWinds, which I should mention ended the day another almost 8% lower today, Romaine.
All right, let's turn now to the Treasury markets. Of course, we've been talking a lot this year about that steepener trade. Of course, a lot of investors have really piled into that trade, and it paid off pretty well. You look at the trajectory of where 10-year rates went. I think we have a chart that we can show you. It gives you an idea here of where 10-year rates went, and then you sort of pair that up with the positioning that we've seen, at least look through the lens of that commodities future trading data, and it gives you a sense of just how much conviction some traders had. But that conviction has really been dialed back a little bit over the past few weeks. A lot of concerns here about what the next move is by the Fed. The idea here that the Fed, while they would certainly encourage some degree of rate rise here, that they would actually want to cap that to a certain extent, at least here in the short term. So the Fed right now looming large over this trade, a trade that's paid off so far. The big question, I guess, is what do we hear from the Fed tomorrow? And will they really give any sort of signal here as to what's going on? For more, let's bring in Ira Jersey of Bloomberg Intelligence, of course, knows way more about this than me, you, and anyone else. Ira, what are your general expectations for tomorrow?
Yeah, so the market's pretty split on whether or not the Federal Reserve is going to do that maturity extension that you mentioned, Romaine. I think the Fed will actually hold off a month. I think that they'll wait to see just a little bit more data, get another payroll print, a couple of retail sales prints in there, to be able to see, how bad the winter might get, even though we're getting the vaccine. But at the same time, there is the possibility that if they don't do that, that bond yields might rise a little bit. So, there's different ways to analyze this. And I think on the 10-year yield, I think we go back and test the highs of about 98 basis points where we were a couple of weeks ago. I don't think that even if the Fed doesn't do that, that they'll break 1%. The reason being that even though the statement might disappoint those people who want to see them buy more longer-term bonds, I think that Jay Powell during the press conference will say it remains an option, we're still looking at it, and we'll do it if we think we have to, and that'll move things back down toward 95 and maybe even close the day pretty much where we are now.
So Ira, do you think for here on out there is basically a cap on 10-year yields at 1%?
I don't think so. I think, though, what you do need to happen is have the global economy look like it's going to pick up steam. You see the efficacy of the vaccines in the first and second quarter, and then you wind up seeing bond yields do get above 1%. We think sometime in the mid to second half of 2021. So something that's going to persist forever that we don't break 1%. But I think in the near term, so tactically in the next 3-4 weeks, that we probably will hover kind of just below 1%. One thing to remember, when bond yields move, they tend to move in fits and starts and then find new ranges. So what we look at, we do look at the technical levels of bond yields, and the 10-year bond yield, if it breaks 98 basis points, 1% is a meaningless number on the charts, by the way. 98 basis points is important. Above that, 1.17% is the next level for the 10-year yield. And then I think we reach kind of there, and we'll make a new range, maybe 105 to 117, and then the market will reassess for a long time what the next move for the economy is going to be, and that will ultimately drive where bond yields are going.
Ira, we just have about 30 seconds, but quickly, tomorrow, is there anything that the market's going to care about other than details on this bond buying program and potential tweaks?
Probably not from the Fed. I think that if we do get some new news on what a fiscal stimulus package might be like, that could potentially move bond yields and markets, and particularly the TIPS market might care a lot about that. So you notice inflation expectations have been rising up toward 2%, and if they break 2%, then they're going to be making new multi-year highs in the market's expectation for inflation, and I think that can be very important and very signaling for what might be next for bond yields in general.
Ira Jersey, we thank you so much for Bloomberg Intelligence. He'll be a busy man tomorrow, of course. Meanwhile, let's get to our other busy man. Mark Crumpton's here with the First Word News.
Caroline, thank you very much. Senate Majority Leader Mitch McConnell congratulated Democrat Joe Biden as president-elect today. The Republican leader's statement delivered in a speech on the Senate floor ends weeks of silence over President Trump's defeat. It came a day after electors met and officially affirmed Mr. Biden's election win. As he departed Wilmington, Delaware to campaign for Democrats in the Georgia runoffs for U.S. Senate, Mr. Biden told reporters that he called Leader McConnell to thank him for the remarks.
I had a good conversation with Mitch McConnell today. I called him to thank him for the congratulations. Told him, although we disagree on a lot of things, there's things we can work together on. We've always been straight with one another. and we agreed we'd get together sooner than later. And I'm looking forward to working with them.
In his remarks, Leader McConnell said, quote, "Many of us had hoped the presidential election would yield a different result, but our system of government has the processes to determine who will be sworn in on January 20th. The Electoral College has spoken," end quote. America's top infectious disease expert expects to be vaccinated against COVID-19 as early as this week. It's not just because Dr. Anthony Fauci is still seeing patients. He tells the Washington Post he believes getting inoculated on camera could help boost Americans' confidence that the vaccine is safe to take. Dr. Fauci says between 75% to 85% of the U.S. population must be vaccinated to achieve herd immunity. New Yorkers can expect a shutdown of all but essential businesses soon after Christmas. That is according to Mayor Bill de Blasio today. Although Governor Andrew Cuomo will make the final decisions, Mayor de Blasio says closures will be similar to what the city experienced last spring, with the exception that schools will remain open. New York City has seen its COVID-19 infections and hospitalizations rise in recent weeks. The New York area is bracing for what could be the worst December snowstorm in a decade. The National Weather Service says a foot or more of snow could blanket the Mid-Atlantic and Northeast starting Wednesday. The storm threatens to snarl road, rail, and air traffic throughout the eastern United States, just as trucks carrying Pfizer's COVID-19 vaccine from Michigan fan out nationwide and carriers are busy with holiday packages. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Romaine?
I'll pick it up from here, Mark. We do have some breaking news. Trump's national security advisor, of course, the acting security advisor being Charles Kupperman, has cut a trip short for talks on the hack. Of course, this hack is the one we just mentioned ago that was revealed by FireEye involving SolarWinds software, has affected a number of government agencies, Romaine, but a breaking news just crossing the terminal that the national security advisor is returning early from the Middle East and Europe for talks on that hack, Romaine.
All right, a very important story. We're actually going to have a lot more of that on our next program, What'd You Miss? I want to take you back now to what's going on here with the pandemic. Of course, arts organizations, they've been hit especially hard. Of course, venues around the world have gone dark. Bloomberg's Janet Wu, she takes a look at how two symphonies out there are finding a way back into the spotlight, bringing new concerts and music to an even bigger audience.
The orchestra is an art form with no personal space. Musicians perform shoulder to shoulder to synchronize as one. When the pandemic struck, the Boston Symphony Orchestra immediately canceled its season.
We have, candidly in Boston, maybe the largest audience along with Los Angeles. So in the course of a year, we've lost about $50 million in ticket sales and other earned income.
How does an orchestra perform when there's no room for social distancing? You make room. Here at Boston Symphony Hall, they more than doubled the size of the stage.
We've taken a 2,400 square foot stage and made it close to a 6,000 square foot stage. And all the string players are 6 feet apart. The brass section is basically in a different zip code than the strings, but somehow we've learned our physics. Sound and light travel at different speeds, so everyone's had to make the appropriate adjustments, and then we're making music again.
All this is possible because 120 years ago, BSO founder Henry Higginson had the uncanny foresight to build a concert hall with removable seats. The seats are taken out for Pop's dinner concerts and even for an elite squash tournament.
But no one ever dreamed these century-old seats would help the BSO face the pandemic.
And one of the great ironies is we're reaching more people than we've ever reached.
Nearly 20 million unique viewers since performances went online.
We're touching more lives with music than we ever have before, 6 continents, 88 countries, and so we're able to fulfill our mission.
The Dallas Symphony Orchestra also got creative.
We did, believe it or not, 90 concerts outside, chamber musicians all around Dallas on streets, driveways, cul-de-sacs, parks.
And indoor concerts with just 42 musicians. The audience is capped at 150 in a hall built for 1,800.
people would shout thank you from the audience to the orchestra as they were getting off the stage, which was just so poignant.
The silver lining is that someone with tickets all the way up here can now get this close to the musicians.
You get angles, you get perspectives that you can't have in a normal concert.
Facing incredible challenges, the BSO and DSO are determined to come back, knowing music is more important than ever. In Boston, Janet Wu, Bloomberg News.
You can catch a holly jolly celebration with the Dallas Symphony Orchestra in partnership with Bloomberg Television on Friday at 7 p.m. Eastern Time. You don't want to miss it. Romaine Bostick even sings a little ditty.
Do
Mr.
I?
Bloomberg.
It's gonna be big.
Welcome back. Now, Senate Majority Leader Mitch McConnell said his chamber will stay in Washington until a coronavirus aid package is complete, reiterating his call to move forward with items that have broad agreement, but also leave aside contentious issues like liability protections and, of course, all-important aid for state and local governments. For more on the state of talks, I'm pleased to say we're joined by Congressman Brendan Boyle, Democrat of Pennsylvania. Wonderful to have you with us, Congressman. And these contentious issues, should they be set aside? Should a smaller package be put through right now?
Look, the American people need help, and they needed it yesterday. I've already voted for two packages, one in May, the other in October, both called the HEROES Act or HEROES Act and HEROES Act 2.0. Unfortunately, in that time, absolutely nothing has passed the Senate over the last 8 months. I'm certainly open to the idea of pushing forward with what we can agree to, and then returning to those items that are left to be agreed upon. But let's be clear, there's no reason why we should be here 8 months later still attempting to reach an agreement on another round of direct stimulus payments, another round of PPP, desperately needed aid to state and local governments. No, Senator McConnell, it's not a blue state bailout. It's attempting to backfill the budgets of all of our states and municipalities that have had such a sudden drop in revenue because of COVID-19. We cannot be laying off our first responders and our teachers, et cetera, in the middle of a pandemic.
We are, as you mentioned here, Congressman, it has been months since the provisions in the CARES Act began to expire, months of inaction by Congress. I am curious as to whether you think that the tone would change once the new Congress is sworn in next year, and obviously President-elect Biden takes over. It's still going to be a very narrow margin in the Senate, and you still have a leader in Mitch McConnell who is opposed to some very fundamental ideas about what the Democrats have proposed.
It's not just opposed to certain ideas. Back in the night before Inauguration Day in 2009, in a famous anecdote now that has been verified, House Republican leadership got together and decided they wouldn't agree on anything with President Obama. They decided to pursue a path of obstruction. Mitch McConnell obviously followed through on that when he became Senate Majority Leader a few years later.
You think he's going to do the same thing with Biden?
Excuse me?
You think he's going to take the same approach with Biden?
Yeah, so what I was trying to say is the question then for Senator McConnell is, will he pursue this obstructionist path before it was done to attempt to get them back into the majority? Now that they are in the majority, the question is, will they be willing to do something with it? My hope is that they will realize that what they are doing is only eating their own, that they are enabling more extreme voices and candidates on the Republican side to actually take them out in primaries, that it's actually in their political interest to work with us and work with the President Biden.
Congressman, the clock is ticking. The stopgap funding bill runs out on Friday. Is there a risk that we don't get something done in the next 3 days?
Yeah, you're raising a separate but also vital issue. That is, regardless of what people think should be done on COVID, whether you call it stimulus or, as I call it, relief, the reality is, separate of that, government funding runs out December 18th. So if we don't pass legislation, we would be in the middle of the pandemic, in the middle of attempting to roll out vaccines we would be facing a government shutdown. Now, the good news on this is I am actually pretty optimistic that we will see the government funded, that we will push forward on a bill that will get this through, not just a week bill or a 2-week bill, but actually will get us through to the end of the fiscal year, September 30th. On that point, I am optimistic.
All right, we will see what happens in the next couple days. Our many thanks to Congressman Brendan Boyle. He, of course, is a Democrat joining us from Pennsylvania. And guys, it does raise a question for me. The original package we were talking about with Nancy Pelosi was $2.2 trillion. Even if this $908 billion compromise package goes through, both parts of it, it's still half the size of what was originally proposed. My question is, will it do enough?
Yeah, I mean, go ahead, Caroline.
That's the key question, guys. Is it enough? The market seem to think it is enough. I almost feel like any sort of deal will keep the market supported here, and they want to move forward, and they want to start seeing them. They're looking past this, past the vaccine rollout, and at the moment we're at record highs. It's quite amazing.
Yeah, record highs here. And of course, a lot of news here that came out through the day. I mean, we kind of touched briefly, Caroline and Kailey, on that Russian hack, of course, that has really seemed to just involve not only a lot of companies, but now, of course, we're starting to get the Trump administration response to it. We're going to talk a lot more about that on the next show. Kailey, you're going to be here for that?
I won't. This is it for me, Romaine. I think you knew that, though. Bloomberg Markets The Close. That wraps it up for our coverage. What you miss is coming up next. This is Bloomberg.